A lot of people hear stocks and think gambling, charts, or rich people stuff. Strip all that away. A stock is simply ownership. That's it. When you buy a stock, you buy a small piece of a real company. Think about a lemonade stand. Someone wants to start one, but they need money for lemons, cups, and a table. Instead of taking a loan, they sell ownership. They split the stand into 100 equal pieces. Each piece is a share. If you buy 10 of those pieces, you now own 10% of the lemonade stand. You didn't lend money. You bought part of the business. A stock works the same way. Big companies divide themselves into millions or billions of shares. When you buy one share, you own a tiny slice of that company's stores, products, cash, and future profits. You are an owner, even if your slice is small. So why does ownership matter? First, value. If the lemonade stand becomes popular, more people want a piece of it. Those shares become worth more, and you could sell yours for a higher price. That's how people make money when stock prices go up. Second, profits. If the stand makes extra money, the owner might share some of it with the people who own pieces. In the stock world, that payout is called a dividend. Not every company pays one, but the idea is the same. Of course, ownership also means risk. If the lemonade stand struggles, your piece is worth less. Stocks go up and down because opinions change about how well a business will do in the future. The stock market is just the place where people trade these ownership pieces with each other. At its core, remember this: a stock is not a bet, it's a slice of a business.